前呢，我想先从总体上跟大家分享3个方面的事项。第一个就是上市后公司治理情况的调整，第二个就是近期监管的一些动向和我们的理解，第三个就是未来监管趋势的判断和我们的主要的举措。
Hello, and thank you everyone for joining our fourth quarter 2020 earnings call. Before discussing our quarterly results, I would like to provide updates on 3 different aspects of our business. First, changes to our corporate governance structure since becoming a U.S.-listed company. Second, our interpretation of recent regulatory development. And third, our view of future regulatory trends, as well as the steps we are taking to stay in front of these changes.
第一个方面就是我们快速反映了美股上市的规则，重组了董事会以及相关委员会的人员构成。在公司治理方面，那么李连杰董事长由于年龄原因，向董事会提出了退休申请。为严格遵照美股上市公司的规则，公司于1月29日召开董事会，审议通过了董事会和相关委员会人员重组的议案，接受李连杰董事长的退休申请及其余4名股东董事、1名独立董事的辞任，新增唐云伟、李祥林2位学者为独立董事，以及李瑞1位股东代表董事。作为前联席董事长及陆控执委会主席，我个人将继续担任董事长。重组后的董事会成员共计9人，其中执行董事3人，股东董事1人，独立董事5人，符合纽交所上市公司董事会独立董事人数需过半的要求。同时，审计委员会、提名及薪酬委员会全部由独立董事组成。作为美股的上市公司，新一届董事会将持续致力于提升公司治理，完善对小股东的保护，高效合理的战略决策。
Starting with corporate governance, Mr. Ren Jieli, chairman of the board, has submitted his retirement application as he reaches the golden age of 65. In strict adherence to U.S. listing regulations, our board held a meeting on January 29 and approved Chairman Li's retirement, along with the resignation of 4 other shareholder directors and 1 independent director. As previous co-chairman of the board, I will now assume the sole role of chairman of the board, in addition to my role as chairman of Lufax Executive Committee. We have also appointed Mr. Yunwei Tang and Mr. David Xiangling Li as our independent directors, and Mr. Rui Li as our shareholder director. Following these changes, our board now consists of 9 directors, among whom 3 are executive directors, 5 are independent directors, and 1 is a shareholder director. Additionally, our nomination and remuneration committee, as well as our audit committee, now solely consists of independent directors. Such changes have brought us into full compliance with the NYSE listing requirements for a majority independent board, and for both of the aforementioned committees to solely consist of independent directors. As representative of a U.S. listed company, our new board of directors will remain dedicated to improving the company's corporate governance, protecting minority shareholders' interests, and establishing prudent corporate strategies in an efficient manner.
同时呢，董事会也审议通过了陆控联席 CEO 的管理架构，由赵荣士和季奎生出任陆控联席 CEO， 分别分管陆控零售信贷和财务管理业务。新的管理架构将更加有利于2大业务板块的联合和资源整合。
In addition, after careful reviews and thorough discussions, our board of directors has decided to adopt a co-CEO executive structure. As a result, Mr. Young-Suk Cho and Mr. Gregory Dean Gibb will serve as the company's co-CEOs going forward, with Mr. Cho in charge of our retail credit facilitation business and Mr. Gibb in charge of our wealth management business. We strongly believe that this new management structure is in the best interest of all stakeholders, enabling us to cultivate more synergies across business segments and better integrate our overall business resources.
我再补充一下，那么YS 除了在分管它的信贷业务的同时，还要协助我管理财务、企划跟资金业务整个陆控的。
In addition to his roles as running the retail credit facilitation business, he will also assist me in managing the finance, planning, and treasury functions of the company.
Greg 除了分管财务管理业务以外，还要协助我分管科技跟投资的关系。
And in addition to running the wealth management business, Greg will also assist me in managing the technology and IR functions of the company.
第二个方面介绍就是监管趋势呢，我们认为进一步趋严，但是长期呢是利好头部企业。那么2020年金融科技的行业的监管呢持续趋严，尤其是在20年末以及今年年初，监管机构相继发布了互联网小贷管理办法征求意见稿、平台经济反垄断指南、商业银行理财子公司理财产品销售管理暂行办法征求意见稿、关于规范商业银行通过互联网开展个人存款业务的通知等多项新规。监管方向聚焦于审慎创新、反垄断、消费者保护、金融稳定和金融安全。在行业面临强监管的形势下，陆控总体的思想是拥抱监管、积极沟通、良性互动。我认为更严格、更规范的监管要求对像陆控这样的头部科技企业是短期承压、长期利好，其在公司具体业务上体现在以下几个方面。
Now, turning to regulatory development, fintech industry regulations continue to be tightened in China throughout 2020. At the end of 2020 and beginning of 2021, for example, regulators introduced a series of new regulations, including the interim measures for the administration of online microfinance business, the antitrust guidelines for the platform economy industry, the interim measures for the administration of sales of wealth management products from wealth management subsidiaries of commercial banks, and the notice on regulating commercial banks to conduct personal deposit business through the internet. At a fundamental level, these regulations represent the government's desire to promote prudent innovation, prohibit monopolistic practices, protect consumer interests, and maintain financial stability and security. Facing increasingly stringent regulatory oversight, we have adopted an overarching strategy of embracing regulatory change, engaging in proactive dialogues with regulators, and forging collaborative and productive relationships with local authorities. While we do recognize that stricter and more standardized regulatory requirements may result in some short-term pressure on the company, we also believe that such changes should foster more long-term benefits for fintech market leaders such as Lufax. Now allow me to elaborate on how these policies have impacted our own businesses.
第一，在零售信贷业务方面，理解监管内涵，沟通业务价值。我们了解到，目前监管的基调是，一方面不希望借款成本太高，另一方面不鼓励年轻人透支消费。就借款成本，根据最高法最新的司法解释，4倍的 LPR 利率上限不适用于金融机构及地方金融组织。我们已经于2020年9月将所有新增贷款的综合借款成本降低到24%以下，符合目前的司法解释及监管要求。有别于其他互联网平台的消费借贷业务，陆金所的信贷业务主要服务于小微企业主，主要用途也是日常经营领域，除了支持国家实体经济发展，是符合政策导向的。在这个方面，目前虽然面临比较严的监管压力，但我们也在积极持续的与监管沟通，希望他们更加理解我们业务的意义和价值。
First, for our retail credit facilitation business, we seek to thoroughly understand the spirit of regulations and proactively communicate the value of our services to the regulatory authorities. Our understanding is that current policies intend to prevent excess consumer borrowing costs and overextension of consumption and credit limits by younger consumers. In respect to lending costs, the latest legal explanation from the Supreme People's Court of China stipulates that the 4 times LPR interest rate cap is neither applicable to the lending businesses of financial institutions nor local financial organizations. Since September 2020, we have restricted our all-in lending costs for facilitating all new loans to no more than 24%, which is in line with the latest requirements. What is noteworthy is that our loan facilitation services differ from other internet consumer lending services in borrowers' use of loan proceeds. We primarily serve micro and small business owners and meet their operating needs. In doing so, we help the physical economy to grow and prosper, which is in full alignment with policy directions. Although we face temporary pressure from the uniform enforcement of regulations across the board, we are engaging in active and persistent dialogues with the regulatory authorities so that our business's mission and societal value are fully understood and appreciated.
第二个方面，在财富管理方面，我们下架了存款引流，目前专注于财富管理和科技赋能。1月15日，央行与银保监会正式下发了规范商业银行通过互联网开展个人存款业务的通知。在此之前，我们已经下架了互联网存款产品。由于互联网存款产品占总收入的比重比较低，预测对我们的业绩影响是有限的、可控的。业务增量方面，平台将持续加强标准化产品、结构化产品，通过极致的销售匹配、用户体验支撑业务的增长，同时继续加强对中小银行全面科技赋能。
Secondly, for our wealth management business, we have stopped facilitating online deposits and shifted our focus to wealth management technology empowerment. In fact, before the PBOC and the CBRC jointly issued the notice on regulating commercial banks to conduct personal deposit businesses through the internet on January 15, 2021, we had already ceased offering online deposit products. Since these products only represent a small portion of our total income, we expect that the financial impact of these adjustments on our business will be both limited and manageable. Looking ahead, we will continue to promote standardized products and structured products on our platform, propelling the growth of our business through superior product recommendations and user experience. We will also continue to work towards empowering small and medium-sized commercial banks through advanced technology.
路控作为在美国上市的企业，将严格遵守中国和美国2个国家的法律监管，积极响应监管的要求，致力于使我们的业务更加合规、更加透明。我相信凭借我们独有的 HubSpot 模式，能够在严格分业监管下实现可持续增长。这次针对金融科技公司的强监管，可能对一批中小平台冲击更大，但是路控作为行业内的头部企业之一，我们的技术能力、管理能力、定价能力、抵抗风险的能力会更强，长期来看对我们是更加有利的。
As a U.S.-listed company, Lufax will remain in compliance with the regulatory rules of both China and the United States. Moreover, to improve the compliance and transparency of our business operations, we'll also remain vigilant of relevant regulatory development. We believe that our unique hub-and-spoke model will enable us to enjoy sustainable growth even under strict regulatory oversight. Although the increased scrutiny towards fintech companies may severely affect small and medium-sized platforms, we believe that stricter regulations will be more advantageous to Lufax in the long run. As an industry leader, Lufax possesses advanced technological capability, sophisticated management know-how, strong pricing power, and versatile risk mitigation expertise, all of which should enable us to thrive in any environment.
第3个大的方面，我们是积极响应政策，前瞻性的布局市场。最后，我想分享一下对未来监管政策的展望。正如3季度季报报告会中我所指出的，对于零售信贷业务，我们预测新的监管方向主要包括在以下方面： 1. 利率上限； 2. 额外资本金的需求； 第3. 捆绑销售是展业地域的范围； 5. 资金方自建的风控系统； 第6. 贷款用途； 第7. 消费者保护。那么针对这7个方面，公司已经在积极准备。除降低成本的措施外，截止2022年12月末， 公司已按计划提升整险风险承受比例到 6.3%， 并计划在2021年中期将所有新增风险承担比例上调至 20%。 根据我们的预测，我们的净资产足以覆盖未来潜在的资本金需求。在展业地域范围方面，近年来我们已在全国各主要城市设立分公司，全国展业是不存在障碍的。在资金合作方面，我们将积极与资金方合作，配合资金方进行风控合规的建设。在消费者保护方面，公司已对 APP 及产品流程进行了更新，给借款人更多的征信方的选择，加强消费者保护，对消费者投诉进行及时妥当的处理。
Finally, I would like to share our views on the future development of regulatory policies. As mentioned on our previous quarterly earnings call, we expect that regulations for retail credit facilitation will focus on 7 different areas, including interest rate cap, capital requirements, bundled sales, geographic coverage restrictions, funding institution risk management, use of perceived verification, and consumer protection. We are actively preparing our businesses to maintain compliance in those 7 aforementioned areas. In addition to lowering our lending costs, we have also increased our overall risk-taking rate to 6.3% as of December 31st, 2020. By mid-2021, we intend to have increased our overall risk-taking rate to 20% for all new loans facilitated. Based on our analysis and forecast, we will have sufficient net assets to cover potential capital needs going forward. In regards to geographic coverage restrictions, in recent years, we have established branch offices in key cities across the country to ensure that our nationwide operations remain smooth and compliant. Furthermore, on the consumer protection front, we have upgraded our apps and processes, implementing more timely response protocols for customer complaints, and providing our borrowers with more credit enhancement choices to better protect their interests.
综上所述，我们认为公司已经在应对未来监管的不确定性方面做了充分的准备，并且时刻保持与监管的沟通。我们有信心在合法合规的前提下完成业务的平稳转型，通过精细化的管理、科技能力的提升来优化成本，同时匹配定价和风险策略。我们也有信心确保利润的稳健成长。
In conclusion, we believe that we are well prepared to navigate through the regulatory uncertainties as we engage in active communications with the regulatory authorities. We are confident that we will complete our business transition smoothly while maintaining regulatory compliance. With our refined operational processes, technology-enabled cost optimization, and risk-matching pricing mechanism, we should be able to sustain our healthy and proper growth for the long run.
好，我再把第3方面说完之后，接下来呢，我请 Greg 具体报告一下公司的经营情况。
I will now give the floor to Greg who will share our business updates for the quarter.
Thank you, Chairman Xi. Before I begin, please note that all the numbers are in RMB terms, and all comparisons are on a year-over-year basis unless otherwise stated. In the face of regulatory uncertainties and overwhelming market noise, we upheld our commitment towards driving high-quality and profitable business growth. As such, we exceeded our previous guidance, delivering solid financial and operating results in the fourth quarter of 2020. As of December 31, 2020, our balance of loans facilitated have grown 17.9% to 545 billion, while our client assets and wealth management have also grown by 23% to 426 billion. Moreover, for the full year of 2020, our total income grew by 8.8% to 52 billion, while our non-IFRS adjusted net profit grew by 2.1% to 13.6 billion. Underpinning these positive outcomes were several driving factors. First, we continue to observe improvement in our credit quality. The C to M3 flow rate, the leading indicator of risk performance on our lending platform, continued to stabilize around its pre-COVID-19 levels. In Q4 2020, our flow rate was 0.4% as compared to 0.4% in Q4 2019. Additionally, our 30 days past due plus further improved to 2% in the fourth quarter from 2.2% in the third quarter of 2020, while our 90 days past due decreased to 1.2% in the fourth quarter from 1.3% in the third quarter. Second, we received more clarity surrounding the implementation of the application of interest rate caps. We're pleased to see, as Chairman Xi just mentioned, the recent Supreme Court guidelines and local court cases providing additional clarity on the interest rate cap. These developments were largely in line with our expectations, and all of our loans from September 4th last year have been below 24%. We do not expect any further adjustments to our lending rates in the short term. Third, in line with our plans, we continue to make good progress in establishing a more sustainable risk-sharing business model. It's encouraging to see that our funding and insurance partners have remained supportive and embraced this new model. As of December 31st, 2020, our outstanding balance of loans facilitated with guarantees from third-party insurance partners decreased to 88.8% from 95.6% a year ago. Moreover, Ping An P&C accounted for 77.7% of new loans sold in the quarter, down from 93.2% a year ago, while our funding partners bore the risk for 6.7% of new loans in the fourth quarter. Fourth, we further penetrated into our core and target customer segments. During the fourth quarter, 72.7% of new loans facilitated were dispersed to our core segment of small business owners, up from 63.1% in the same period of 2019. In the wealth management business, the contribution from customers with investments of more than 300,000 RMB as a percentage of our total platform client assets increased to 75.5% as of the fourth quarter versus 73.1% a year ago. Moreover, our 12-month investor retention rate remained high at 96.8% as compared to 93.3% in the same period of 2019. Lastly, we observed strong growth in our current product client assets in the wealth management business. Current product client assets grew by 67.2% year over year and thus accounted for 95.5% of our total client assets as of the quarter end. The remaining legacy client assets decreased to $19.4 billion, or 4.5% of total client assets as of the quarter end. Next, let me provide some more context regarding new loan sales, take rate, and pre-tax margin in the fourth quarter. In retail credit facilitation, our new loan sales for the quarter were $132.7 billion, slightly ahead of our prior guidance and representing a 3.2% year-on-year increase. We also observed stable credit demand from our small business owners in Q4, as well as a very strong start to the new year. In fact, for January 21, we just recorded our highest ever single month new loan sales, representing a year-on-year a double-digit increase. As a result of our adjustments to borrowing costs back in September 4th last year, our revenue take rate did experience temporary pressure in the fourth quarter, declining to 9.1% in Q4 from 10.3% a year ago. As these adjustments at the time occurred overnight, we believe this decline is temporary in nature. And nevertheless, we're now renegotiating with our partners to reduce our funding and credit costs as we continue to adjust our cost structure that will take some time. We believe our revenue take rate and net margin will improve in the future throughout the course of this year. I'm going to circle back on this in just a moment to explain to everyone how we're going to get there in 2021. For now, despite the regulatory uncertainty, we expect double-digit top-line and bottom-line growth going forward through this year. As I mentioned, we've already had a very strong start for the year, recording the highest ever single month new loan sales, while maintaining the full and steady backing of our insurance and funding partners. We also decreased our sales commission rate starting this January, and we continue to optimize our funding costs, and we started to enjoy lower CPI costs as insurance partners adjusted their pricing on the back of better credit and customer quality. All of these factors are leading to a recovery in pre-tax net margin as compared to Q4 2020, as we expect this trend to continue throughout the remainder of 2021. Due to the complex accounting treatment of revenue recognition for loans that we facilitate versus trust-funded loans, and the initial recognition of credit costs for our risk-bearing loans, there will likely be some quarterly volatility in our net margins, which James will elaborate more on next. But in spite of this, our strong performance in January has given us confidence in the healthy momentum of new loan sales, as well as our underlying unit economics. In fact, after overlooking the accounting treatment complexities, we believe that both, and here we're talking about take rate and unit economics, have already bottomed out and will continue to improve throughout 2021. For our 2021 business priorities, we'll continue to monitor the new regulatory requirements and be prepared to adjust quickly when required, similar to how we have operated in the past. Now, as we look ahead in retail credit facilitation, the stabilization of borrower rates and continued optimization of external and internal costs are expected to improve our underlying unit economics. We will also continue to execute our plans for the new risk-sharing model, diversify our funding channels, secure more funding partner support, and enhance our deployment of technology. In wealth management, we will prioritize revenue optimization and product mix over client asset growth. The reason we have made this decision is in reflection of the tightening regulations in some areas that we've seen, such as the bank deposit distribution. But we expect revenue growth to be in line with our own expectations as we explore more qualified investor products and increase our focus on those insurance and equity-related products capable of generating better returns for our business. Our two businesses will also be working together to expand our technology-enabled services in lending and wealth management to small bank partners. We expect this strategy to deepen our ties with the partner banks and to generate additional revenue opportunities. I will now turn the call over to James Young, our CFO, to go through the financial details.
Thank you, Greg. I will now provide a closer look into our fourth quarter financial results. Please note that all numbers are in RMB terms and all comparisons on a year-over-year basis, unless otherwise stated. We continue to deliver solid financial results in the fourth quarter of 2020. Our total income was 13.3 billion, up 5.9% year-over-year. More importantly, our net profit increased by 17.4% to 2.8 billion in the fourth quarter, while our net profit margin further expanded to 21.4% from 19.3% in the same period of 2019. Before diving deeper into our Q4 numbers, I want to highlight two factors that create a mismatch between our revenue and earning growth and the actual business growth. These factors have impacted our 2020 Q4 results and will continue to impact our 2021 results. First, our increase in on-balance sheet loans slows the pacing of revenue recognition in comparison to that of off-balance sheet loans. Revenue and expenses are recognized over the life of a loan. For loans that will facilitate, retail credit facilitation service fees are recognized under IFRS 15, and a great portion of the revenue is thus recognized in month one, reflecting a larger portion of the service that is provided to the borrowers in month one. We utilize trust as a funding channel. Certain trust-funded loans for which we meet accounting consolidation requirements are recognized as on-balance sheet lending, and revenue for these type of loans is recognized as net interest income and IFRS 9. Recognition of monthly revenue and IFRS 9 is more evenly spread out across the life cycle of a loan. Furthermore, in IFRS 9, all revenue associated with these loans, whether facilitation, interest, or guarantee in nature, is all recorded as net interest income. whether a loan is funded by a bank, therefore recognized under IFRS 915, or funded by a consolidated trust and therefore recognized under IFRS 9, makes little business difference, as the overwhelming majority of the loans are funded by third parties in any case. However, the accounting treatment differs greatly, as on-balance sheet revenue is recognized at a slower pace than off-balance sheet revenue in month 1, therefore creating a temporary deviation between accounting results and the business performance. Second, self-risk-bearing loans front-load loan credit costs. As we start to bear more risks, we expect to earn more margin over the life of a loan, as the margin previously earned by our insurance partners will now come to us. However, accounting standards require us to record a provision determined by IFRS 9 for the month in which we take on a new loan, while the revenue associated with bearing that risk is recognized over the loan's entire life. This timing mismatch means that our net margin will also be under pressure during those periods in which we increase our own risk-bearing balance. Nonetheless, once this stabilizes, we expect our net margin to return to its previous levels. These factors affect the pace of our recognition for revenue and expenses, creating a timing mismatch between our financial and business results, and will likely result in more quarterly movement and volatility. With that, now let's take a closer look into our Q4 numbers. During the fourth quarter, our total income increased by 5.9%, while our revenue mix continued to change as a result of our business model's ongoing evolution. As discussed earlier, such revenue mix change has slowed the pace of revenue recognition. Following our decision to increase funding from those consolidated trust plans that offered lower funding costs and continued to increase the volume of loans for which we bear credit risks, our net interest income and guarantee income grew significantly to 2.6 billion, or 19.5% of total income in the fourth quarter, from 1 billion, or 8.2% of total income in the same period of 2019. As a result, our retail credit facilitation service fee decreased by 9.9% to 9.3 billion, or 69.9% of total income, from 10.3 billion, or 82.1% of total income in the same period of 2019. The annualized take rate for current products and services on our wealth management platform was 31.4 BPS in Q4 as compared to 21.5 BPS a year ago. We calculate the take rate by dividing total wealth management transactions and service fees for current products by our average current product client assets. As we upgrade our business from product distribution to focus more on providing our partners with comprehensive technology enablement offerings, we are generating a greater portion of revenue from those service fees that are not directly linked to products. In light of this ongoing transition, we believe this take rate measurement better reflects our business and thus plan to continue using it going forward. Now, moving on to our expenses. In the fourth quarter of 2020, our total expenses increased by 11.7% to 9.1 billion, driven by accounting factors related to early customer repayment and the credit cost from self-risk-bearing loans, as I mentioned previously. Our sales marketing expenses increased by 20.5% to 4.9 billion during the fourth quarter from 4.1 billion a year ago. Our borrower acquisition expenses, which are a major component of our sales marketing expenses, increased by 22.3% to 2.8 billion from 2.3 billion a year ago, mainly due to the accelerated recognition of selling expenses that we recorded in the quarter as a result of customers' early repayment. Since we started to change how we charge monthly fees in September 2020, the negative impact of early customer repayments on revenue has largely been minimized. However, early customer repayment also will impact our self-marketing expenses. When a loan is repaid early, we are required to recognize all of the remaining sales and marketing costs that have not yet been amortized in the same month. Therefore, in a period of high early repayment, sales marketing costs are likely to be inflated when compared to actual activity in the period. Meanwhile, our investor acquisition and retention expenses decreased by 17.5% to 237 million in the fourth quarter from 275 million a year ago, mostly due to our improved investor acquisition efficiency as we leverage technology to achieve greater precision in investor profiling and targeting. At the same time, our general sales and marketing expenses, which are mainly comprised of payroll and related expenses for marketing personnel, brand promotion costs, consulting service fees, business development costs, as well as other marketing and advertising costs, increased by 24.9% to 1.8 billion in the fourth quarter from 1.5 billion a year ago. This increase was mainly due to our previous postponement of marketing campaigns and subsequent resumption in the quarter as businesses across the country restarted their operations in the post-pandemic period. Our general and administrative expenses increased by 47.8% to $986 million during the fourth quarter from $667 million a year ago. The increase included employee Social Security payments for the first 3 quarters of 2020, which were previously delayed following the release of government policies made in response to the outbreak of COVID-19. In addition, we also recorded a higher share-based compensation expense for the fourth quarter. Consistent with the growth of our outstanding balance of loans facilitated, our operations and servicing expenses increased by 10.6% to $1.7 billion during the fourth quarter from $1.5 billion a year ago. While our outstanding balance of loans facilitated grew by 17.9% to $545.1 billion as of December 31st, 2020, from $462.2 billion as of December 31st, 2019. Meanwhile, an increase in our loan repayment volume led to an increase in our payment processing expenses and consolidated trust plan fees to trustees during the fourth quarter. This increase was partially offset by our use of AI to improve the efficiency of our loan approval and the collection process, helping to reduce the related costs. Our technology and analytics expense decreased by 17.4% to $461 million during the fourth quarter from $558 million a year ago as we continue to improve our efficiency. Our credit impairment losses increased by 1.4% to $985 million during the fourth quarter from $971 million during the same period of last year. This increase was primarily due to our higher loan-related risk exposure as our business model continued to evolve, causing us to start to bear more risks and record credit impairment losses upfront. The increase was also due to an increase in our loan-related receivables, which was mostly driven due to the residual effects of COVID-19. Conversely, the increase in credit impairment losses was partially offset by the year-over-year decrease in our asset management impairment losses during the fourth quarter. Our finance costs decreased by 17% to $326 million in the fourth quarter from $393 million a year ago, mainly due to the decrease in our borrowing costs during the period. Consequently, our net profit increased by 17.4% to $2.8 billion during the fourth quarter from $2.4 billion in the same period of 2019. Our basic and diluted earnings per ADS were both 1.25 RMB as compared to 1.12 RMB in the same period of 2019. As of December 31st, 2020, we had $24.2 billion in cash at bank compared to $7.4 billion as of December 31st, 2019. Looking into 2021, because of the previously discussed accounting and the temporary business factors, we expect our margin in Q1 to be somewhat impacted, but profit growth to resume starting from Q2 and beyond. For Q1 2021, we expect new loan sales to be in the range of $175 billion to $180 billion, client assets to be in the range of $385 billion to $395 billion, total income to be in the range of $14.3 billion to $14.6 billion, and net profit to be in the range of $4 billion to $4.2 billion. For the first half of 2021, we expect new loan sales to be in the range of $340 billion to $350 billion, client assets to be in the range of $375 billion to $385 billion due to the stoppage of online bank deposits. Total income to be in the range of $28.5 to $29.3 billion, and the net profit to be in the range of $7.8 billion to $8 billion. This forecast reflects the company's current and preliminary views on market and operational conditions, which are subject to change. This concludes our prepared remarks for today.